As we come out of the Easter break, it's scheduled to be fairly quiet, although news flow will pick up speed as we enter the first quarter reporting season in the USA. Top down, the main point of interest will come from America, and it will do so in the form of the Nfib Smaller Companies Business Confidence Survey. This is published monthly, and the latest instalment is due for release on Wednesday the 7th of April. Smaller companies and small cap stocks are useful indicators for investors in two ways. First, they're perceived to be riskier than their large cap counterparts, and generally with good reason. As such, they can be used to judge wider market risk appetite. If small caps are rolling higher, we're likely to be in a bull market, and vice versa. Second, small caps can be a useful barometer of economic activity. There are exceptions to every rule, but normally small caps are younger firms that are still developing. They're potentially more dependent upon certain key products or services, a narrower range of clients, or even key individual executives. And they can also be more exposed to their domestic market rather than overseas ones. This is why the NFIB is particularly interesting this time around. America's main small cap index, the Russell 2000, was up by a fifth in 2021 at its peak, but it then lost 10% of its value in barely a week, as investors reassessed progress in vaccination programs, the easing of lockdowns, and the prospects of greater scope for travel. The NFIB had already come off its top and was trading some 12% below its 2018 high, so economists and analysts will be looking to see if December's $900 billion fiscal stimulus plan under Trump and February's $1.9 trillion plan under Biden have made any difference. And don't forget, the Democrats are now talking about a further $3 trillion infrastructure plan. Your benchmark for the NFIB reading, by the way, is February's score of 95.8. The scheduled corporate news calendar is thin, although possible points of interest include trading statements or results from the following. Please do note that these dates are still subject to change. HomeServe and Next 15 Communications on the 6th of April, Saga and the AA on the 7th, and home furnishings retailer Dunelm on the 8th. But the company which could really cause a fuss in the week ahead is Asos. The online fast fashion retailer is due to publish its first half results on Thursday the 8th of April. These figures will cover the 6-month period to the end of February. Now, Asos shares have more than trebled in the past year, and they are trading close to 12-month highs. Having said that, though, they do still trade somewhere below their 2018 all-time high of near £80. But even allowing for that, investors probably won't be surprised to see the shares having done so well over the past year. The company's strength is online retail, after all. Even before the pandemic, online was gobbling up market share from bricks and mortar retailers, either because of price or convenience, and then lockdowns and the pandemic have only increased the value of online shopping and home delivery in the eyes of customers. Asos raised £247 million from its shareholders last April to make sure it could come through even the gloomiest economic scenario, and since then it's performed consistently strongly, beating or at least reaching the top end of analysts' expectations. January's trading update reveals strong trading in the 4 months to the end of December. Sales in the UK are up by 36%, and by between 17 and 20% in the key overseas regions on a constant currency basis, and those are the first trends that analysts will assess from these interim results. Those numbers meant that total group sales were up by 24% year on year after just 4 months. Analysts think sales would increase by 21% for the year as a whole to around £4 billion, although that will include first-time contributions from the assets purchased from the fallen Arcadia Group, of which more in a moment. As a result of the strong showing in the first 4 months, Chief Executive Nick Baton steered analysts to the higher end of the consensus forecast range when it came to full-year pre-tax profit. As a result, analysts now expect pre-tax income to reach £160 million against £142 a year ago, and this includes the company's estimate of a net £40 million benefit from COVID-19, as lower customer returns more than offset costs associated with keeping staff safe and any supply chain disruption. In the first half of last year, by the way, Asos made £30 million pre-tax. Above and beyond the headlines, analysts will then dig down for the following 3 items. They'll be looking for more detail on active customer numbers, site visits and sell-through conversion. In the first half of last year, Asos had 22.3 million active customers, while 1.3 billion site visits turned into 41.1 million orders for a 3.1% conversion rate. The retail gross margin fell to 45.9% for the whole of last year, a drop of 1.5 percentage points. The company has focused on costs, but it is adding warehouse capacity, and analysts will be also looking towards the impact of higher cotton and raw material prices, higher shipping costs, stock availability, and any impact from Brexit and tariffs, which the firm has thus far suggested could cost it around £25 million. Finally, analysts will look at the balance sheet. Asos had £408 million of net cash at the end of its full year, although it has since acquired Topshop, Topman and Miss Selfridge from Arcadia for £265 million. Shareholders and analysts will also look for comments on the integration of those assets acquired from Sir Philip Green. Asos has already flagged up some £20 million in costs here, and they're expected to offset any profit uplift from the new purchases in this financial year. Investors will also look for an update on capacity expansion as the firm ramps up a warehouse in Lichfield to complement the existing UK site in Barnsley and also expands local delivery capability in America. All of these charts, by the way, only go back to 2012, as that's when the company shifted its financial year end to August. I hope that you and your families are all in good health and good spirits during these difficult times. Thank you for listening, and I look forward to talking to you again next week.